Fed is signaling an intervention again, just like in 1985. Last time this happened, the dollar crashed by over 50%. In 1985, the US dollar became way too strong. US factories were losing business and exports were collapsing. And off the back of this, trade deficits were exploding. So the US, Japan, Germany, France, and the UK came together to make a deal to purposely weaken the dollar by selling dollars directly to buy other currencies, a forex trade. Over the next 3 years, the dollar lost over 50% of its value. USD JPY moved from 260 to 120, and the yen doubled in value. Now, what happened with a weaker dollar? That pushed gold higher. It also pushed commodities higher, non-US markets higher, and all asset prices in dollar terms. Now let's look at today. US is running one of the biggest deficits ever, and currency imbalances are at its highest. Actually, Japan and yen are the main problem right now. The yen again is extremely weak and causing stress on the markets. This is why the Plaza Accord 2.0 is in discussion. Last week, the New York Fed did a rate check on USD JPY, the exact same thing that started the Plaza Accord in 1985. That signals the willingness for the US to sell dollars for the yen. Now, no intervention has happened yet, but the markets have moved anyway. So if this does start again, then asset prices will skyrocket. And one of the biggest ones that will be affected by this will likely be crypto and Bitcoin. And they'll have one of the biggest catch-up trades of the year, as it is super undervalued in comparison to AI, equities, and metals right now. I'm going to be hosting a completely free live workshop going over all of this to do with metals, equities, crypto, the undervaluation, overvaluation of markets, and how macro policies like this will affect the crypto and Bitcoin markets over time. If you want to join me live, make sure you comment webinar down below.